Okay, let's take a look at the lifetime value of a customer. We're going to use the tablets or us example that's on Moodle. We need to know 4 things before we calculate the 5th, which is our lifetime value. We have to know the retention or the defection rate, the life cycle of the buyer, which is how long the buyer will stay with us, the repurchase frequency. How many buys does a customer do in a year? The contribution margin, how much each customer over their lifetime contributes to overhead and profit. And from these, we can calculate the lifetime value. So let's just start with the retention defection rate. They're really the same thing. It's all how you calculate it. We were given, in our tablets RS example, the 75% retention rate. What this is telling us is for every 100 customers we have this year, we'll have 75 of them again next year. So we have a 75% retention rate. As an initial step, we're going to calculate the defection rate. Now, if we have 100% customers, of our customers, 75% of them we're going to keep or retain. So our defection rate is 25%. Now we'll calculate the second one, which is the life cycle. The life cycle of our buyer. What we use, we could do this 2 ways. When we're first doing it, we use the intermediary step here of the defection rate. So all our life cycle is 100% of our customers divided by the 25% that defect. So it's 100 divided by the defection. In this case, it equals 4. We could do one other thing. Once you begin to do this a few times, you know, the first couple times through, it's better to calculate the defection rate. Once you get used to what you're doing a little bit, it's a lot simpler if you combine steps 1 and 2. So I'll call that B here. We know that our defection rate was simply 100% of our customers minus our retention rate. And we know for the life cycle, we're basically taking a percentage here. We know it looks like this. So 100 minus 75 is 25 into 100, which still gives us 4. All right, so you can do either one. Again, A is you splitting it into separate places, doing the defection rate, then calculating the life cycle is easier once you start. Once you get going, you just can combine steps 1 and 2 into one step. Okay, so step 3 is calculating our repurchase frequency. Notice I just abbreviated RF because it's a lot easier to write out. So our repurchase frequency is just the ratio of our purchases to years. So we just have to know the number of times a customer purchases over how many years, or whatever period you're using. In the tablets R Us, we're using years. So in tablets R Us, it was stated that someone buys a tablet every other year. In other words, they make one purchase in 2 years. So their repurchase frequency is 0.5. Let me do another example. So this is separate than what we're doing for tablets or us. But another example, say the average house buyer buys one house every 7 years. So their repurchase frequency would be one purchase over 7 years. Another example might be that, say that you have a customer that purchases quarterly, or 4 purchases per year. That would be 4 purchases, number of years 1 would equal 4. So if you find that customers purchase multiple times a year, your number will be greater than 1. If they purchase less than a year, you'll find it will come out to a decimal. Okay, let's look at our fourth. We need to calculate the contribution margin, which I abbreviate as CM. To do it, I'm going to use a simplified P&L or income statement. We have our revenue and our cost of goods sold, which are our variable expenses. Sometimes in accounting they're also called direct expenses. We subtract COGS from revenue and it gives us our gross margin. Now, from the gross margin, we subtract out our overhead or our fixed costs and our EBITDA, which is, you learn all about in accounting, which is a lot of fun, but this is where accounting makes their money. And we all know accountants are strange people. Only kidding you, accountants. But what results is profit. And just to give you an example of what I mean, you know, say we have revenues of $100,000. Our COGS, or what it takes us in direct labor in material to make that 100,000 is 55. So our gross margin is 45,000. Let's just say our fixed costs, our overhead, which is rent, our accounting department, our marketing department, everything that's not involved and directly involved with the production or whatever we're producing is overhead. And we'll say that, you know, we have $10,000 in taxes, depreciation, amortization, and it gives us a profit of $10,000. So what our contribution margin is, we can calculate that in 2 ways. Contribution margin is can equal our gross margin, which is our revenue, minus our COGS, or cost of goods sold. And that gives us our contribution margin. Or, generally in operations, we combine overhead and EBITDA, and we call this all just overhead or fixed costs. So that's what I'll do here. I'm just going to call those all fixed. So we take our overhead and we add it to our profit. You notice either way will give us the same number. In this case, we have 100,000 minus 55, which equals 45,000. And in this case, we have 35,000 plus 10,000, which equals 45,000. The other thing we typically do is, I put this out in numbers so you can see, but it's typically done in percentages. Like our revenue is 100%, our COGS would be 55%, our gross margin or contribution margin is 45. I'm going to combine these and call it 35%. and our profit is 10%. So, and 10% is a good profit margin. So, our contribution margin is 45%. Or if you like decimals, 0.45. All right, now let's put it all together to get the lifetime value. Our lifetime value is simply the revenue per unit, how much it costs, our selling price, which was given in the tablets RS example, which is $500. So revenue times our contribution margin, which we just figured out was 45%, in decimal form 0.45. Our repurchase frequency, how many times a year do they purchase? Well, we know from our example it was once every 2 years, so that's 0.5. In our life cycle, we know that was 4. An average customer stays with us for 4 years. We multiply all those together, and we know that our average customer value is $450. All right, say management wants to increase, the retention from 75% to 85%. Everyone wants to keep retention. If you look it up on Wikipedia, they say that if you can increase retention, it's good for you because it costs 3 to 5 times less to keep an existing customer happy than it does to find a new one. Other books say 7 times, but the whole idea is it's a lot cheaper to keep a customer than find a new customer. So everybody wants to increase the retention rate. So the only thing that changes from up here, from our lifetime value, is our life cycle. And if you remember our life cycle calculation, we have 100% of our customers divided by 100% minus the 85%. And I did method B here where I combined them both into one. You could take it in 2 separate steps and first calculate the defection rate and then calculate the life cycle if you so choose. Well, this comes out to 6.667. For our lifetime value, everything else stays the same. So we have 500 times our 45% contribution margin, times our every other year purchase, times the 667. So you can see just a small increase in retention, in this case 10%, it dramatically increases the lifetime value of a customer. One way this might be useful is that if your marketing manager comes up and says, well, if you want me to increase retention from 75 to 85%, I need to develop a new loyalty program. And that loyalty program is going to cost me $200 per customer. Now you have the tool where you can say, tell your marketing manager, yes, that's a good move. Because you can see we're currently at $450. If we can get the 10%, we're at $750. And if it only costs us $200 to do that, we're still making $100 more per customer over the lifetime. Some of the other variables that you see that we're not going to get into in this course is, one big is the discounted cash flows. Which simply means that $1 today is worth a lot more than $1 that's almost 7 years out. So you use your typical, discounted formula for that. Where it would be, you take into account the interest rate, your risk factor, the number of years, and put together a discounted cash flow. And then you just take the individual years and add them up. Some people also do the same thing for increased yield. In other words, typically customers that stick with you tend to buy more each year. So you want to increase, maybe that year 4 they'll buy 2 tablets instead of 1. So you have to account for that increasing yield. Both of these should be covered in finance and are above these course, but it's the same basic method, but except you'd have to break it out on a yearly basis.